Hello, everyone who's already joined us. Welcome to our first live webinar event in what is a very challenging set of circumstances for those who are joining us from Melbourne. We actually had this event originally penciled in as an end of financial year function. So we're pleased to be able to connect with you, albeit in a different forum. And more than likely, this will be the new normal for us for a while. So we hope to deliver more of these events to you in the future. Today, we're also joined by our Brisbane team and their valued clients. For those who are unaware, earlier in the year, we welcomed 2 partnering firms in Brisbane to join the Wealth Architects brand and family. And one of these teams is led by Brian Parket, who'd like to say a quick introduction.
I know myself and my clients are really looking forward to today's presentation. I've been to a couple of Brian presentations in the past, and they've always been very informative and very good. So thanks again for the invite.
Well, good, Brian. So we appreciate you all taking the time to join us today, and aware that in today's world, many of you are juggling quite a few balls. But I trust you will get a great deal of value from today's presentation. As the rest of the country seems to be on the road to recovery, Melbourne and Greater Victoria are facing some devastating restrictions, and from midnight tonight, we are set to see a heartbreaking amount of businesses and industries forced to close. So I'm sure a lot of you are eager to get the views of what this all means from one of Australia's most prominent chief economists. For those who don't know Sunsuper, it's one of Australia's largest and fastest growing super funds with 1.4 million members. And as at October 2019, 70 billion in funds under management. And with that, it's a great pleasure that I introduce you to Brian Parket. Brian joined Sunsuper in June 2015. Prior to joining Sunsuper, Brian worked in a series of economics, portfolio management, and communications roles with a range of firms including Rothschilds, JP Morgan, Citigroup, MLC, and the Reserve Bank of Australia in a career spanning over 29 years. Brian has an honours degree in economics from the University of Queensland, where he also taught macroeconomics and is a chartered financial analyst. Before I hand over to Brian, thank you to those who have already submitted some questions through the registration process. We'll be allowing about 15 minutes of questions at the end. And if you do have a question, feel free to send a message in the chat box on the right hand side of your screen, and we will do our best to have Brian answer these at the end. Thank you, Brian.
Thank you very much for that, and thank you very much, everybody, for your time. Quick word from our sponsors to begin with. This is just general information only, doesn't take into account your particular circumstances. Obviously, the only people who can do that are yourself, and preferably in conjunction with professional financial advisors. So I just thought I'd make sure that I get that out so that the compliance people will be happy with me. Now, let's just sort of summarise the main messages here. Firstly, there's no point in trying to sugarcoat what is going on right now. We are still in the midst of a major global and Australian economic downturn, the worst economic downturn we've seen in any of our lifetimes. And even though we suspect that there is, in a global sense at the very least, there is a recovery of sorts underway, we think the recovery is going to be, and was always going to be, frankly, very gradual, very drawn out, and very uneven, and very subject to setbacks along the way. And that's exactly what we're seeing. We're not just seeing it here in Australia, Victoria being the most obvious example of that, but we're seeing it in other parts of the world as well. We're going to be seeing it in parts of the UK. We're seeing it most notably in California and some of the large southern states of the United States. This is never going to be a smooth path to recovery. The good news, for the most part, I think we can say that we've been pleasantly surprised by the policy steps that governments have taken on the monetary and fiscal side of things, that if you look at the quantum of the amount of money that's been thrown at the problem, they certainly have provided a level of support to the economy that was even larger than the support provided during the GFC. However, we still expect that the governments have more to do. And again, to use Australia as the most obvious example of this, the Treasury forecasts that were announced literally about a week or so ago have been obsolete as soon as they were published. Clearly, the renewed lockdown in Victoria is going to mean that the Australian economy we may not return to growth in the September quarter. That even though the rest of the country has been gradually opening up, the reality is that Victoria is a quarter of the economy, and the flow-on effects from Victoria are significant. That Victoria is a key supplier of a range of manufactured goods, for example, that actually go to supply much of the rest of the country. So the disruption is likely to be significant. More on that as we go on, though. In terms of markets and strategy, now the other thing, just I should clarify, there's always this tendency to sort of say, do you believe in a V-shaped, W-shaped, L-shaped, U-shaped recovery? I don't think any letter really cuts it. That this is not that kind of it's not that kind of an economy, that so much of the recovery depends on variables that are out of the control of economic policymakers and more in the control of all of us, and indeed the health authorities. And what we've seen a very clear example of just how vulnerable economies are to renewed outbreaks. And it's also worth making the point that we're vulnerable even if the outbreaks don't lead to renewed shutdowns, because what we've seen in the United States, for example, is that renewed outbreaks actually lead people to self-isolate, that people actually vote with their feet, i.e. not to move them. And I'll show you a chart on that shortly. Now, in terms of markets and in terms of investment strategy, it's important to bear in mind that if you look back to where we were in March, where share markets were in free fall, and certainly you saw such a collapse in markets risk appetite, if you like, much sharper and deeper than we saw even during the GFC. It's important to remember that every crisis creates opportunity. And this crisis has proven to be and will continue to prove to be no different, at least in that respect, that there have been opportunities to acquire assets at much more attractive prices. It's a job of professional investors to look through the bad news and to look through the heartbreak that this crisis has provided, and to look for investment opportunities. And that's exactly what people pay us to do. Share markets now look extraordinarily cheap compared to other alternative asset classes, most notably cash and bonds. And the big challenge for investors over the next run of years is that the sort of assets that conservative investors typically rely on to protect capital and to provide an income may do neither of those things, especially not in real or after inflation terms. That returns from cash, from fixed income and term deposits are going to be appallingly bad over the next 3 to 5 to 10 years, and that is by design. That literally this is central banks around the world keeping interest rates at extraordinarily low levels for an extended period of time. That is going to be an ongoing challenge for those who are required to build portfolios for conservative investors, particularly those in retirement. There have been opportunities. We have, for example, increased our exposure to equity markets. We have increased our exposure to selected opportunities in credit. We did see non-government bonds around the world really sell off quite dramatically. There were opportunities that did present themselves there, but we've also seen a very sharp recovery in those markets. I think it's also important to comment quickly on what we've seen in share markets, because a lot of questions I get from people are, why have share markets recovered so quickly, given that the world is still an awful place? And I think there's a number of parts to that. Firstly, just a quick question, an unlisted asset. By unlisted assets, I mean assets that are not traded on recognised exchanges or not actively traded in public markets. And this is things like unlisted property, infrastructure assets, and private equity. That's really what I mean by unlisted assets. Sorry, just thought I'd deal with that straight up. When the share market fell in advance of the economy, and that's quite often the case. Share markets tend to be more forward-looking than any of us. So share markets saw the downturn coming before it actually hit. The other important point is that even though share markets fall, they don't always get it right. So a share market fall is no guarantee the economy always follows, but this time you could be pretty certain the economy was going to follow. The second thing is just the extent to which the authorities stepped up, and in particular the extent to which central banks stepped up, and the amount of liquidity that's been injected into the system, and just how low interest rates have fallen to. And so from an asset allocation perspective, if I'm looking at where are the best return opportunities, equity markets actually were the best opportunity in town. And sadly for too many investors, perhaps share markets at the time being do look to be the only game in town, because the returns from other asset classes like cash and bonds are so terrible. The other thing is, it's important to bear in mind, is that share markets are not necessarily the economy. And you see this classically in Australia, where yes, we have a share market that's still dominated by a handful of big banks and a handful of big miners, but they are not the overall economy. The economy is far more diverse than that. In the United States, for example, and I'll share some more information on this shortly, so much of the United States' share market fortunes have been driven by those very large technology companies that have really shot the lights out. But they are not the economy either. They are they are part of the economy, obviously, but the economy is a far more different beast than what you see in share markets. If I go to the next slide. Yeah, this just illustrates how quickly markets have recovered. So this is just the major asset classes that we all might invest in. From the top, the best performing assets this year have really been in fixed income. So this just shows you what happened if I put $100 into each of these asset classes at the end of 2019, what's happened since, and it's updated, I think, to the end of July. Massive fall in share markets, and you'll notice the two worst falls there, A-REITs and G-REITs. So this is Australian and global listed property or real estate investment trusts. Needless to say, physical property assets in general, especially retail assets, not surprisingly, have borne the brunt of much of the lockdown and activity. But share markets really across the globe fell very sharply, but the rebound has also been very steep. We're still not up to where we were before, but we're still very steep. In the very steep and sudden recovery. If I go to the next slide, this just shows you an index of risk appetite. I talked about how quickly markets fell, but how quickly they rebounded. This is a way of aggregating that up. So what it is, it's an indicator of the market's appetite for risk. So it looks at the performance of a range of riskier assets relative to their history, and by that I mean things like share markets, high yield or junk bonds, the performance of emerging markets as opposed to the developed markets, and the performance of highly volatile shares as opposed to more defensive shares. And a negative result means that markets are in panic mode. A positive result means markets are actually pretty positive. And look at how steep that fall was earlier this year. That was a steeper and deeper fall than we saw during the GFC. And this chart goes back to 1999. But also look at the extent of the recovery that we've seen, which has really been quite staggering and has caught a lot of people by surprise. Could you have predicted this? Could you have predicted that markets were going into a downturn? Yeah, you possibly could, but you would have had to have very accurately predicted the virus outbreak and its trajectory. And I don't think many people really did that. But you certainly couldn't have predicted the timing of the recovery and the speed of that recovery, in my opinion. This is where trying to pick these sort of short-term swings in markets, to me, is an absolute mug's game. And like me, I work for a superannuation fund. So our members are relatively young. And so whether we like to admit it or not, we are by definition 10, 15, 20, 30, 40-year investors. And so consequently, managing that kind of money and trying to pick these short-term swings is really a mug's game. If I think about the markets fell first, then the economy did. So this just shows you the extent of the damage, if you like. So this just shows you where a range of economies are compared to where they would be if they'd have stayed on the same growth trajectory that they were on pre-COVID. So the world was actually growing at a modest but fairly sustainable pace at the end of 2019. If we'd have stayed on that path versus where we are at the end of June, that's basically what this chart shows. So where have you seen the most damage? You've seen the most damage in those economies that have had to shut down most severely. So it's most obviously the UK and Spain and France and Italy. Australia being sort of more the middle of the pack. The economies that fared relatively well, Korea, Taiwan, China. Now, let me give one caveat. I don't believe the Chinese fatality numbers. I don't believe the Chinese infection numbers. I think a lot more people have passed away from COVID-19 in China than has officially been recognised. I think that's very clear. But the speed with which they shut down and then were able to reopen, and you're seeing this in the economic data, even the more reliable economic data, has been impressive. Mind you, it also tells you that there are things that Communist Party dictatorships can do to manage things the Western democracies perhaps find harder to do. The other important question I thought would be worth addressing is, and you're seeing a lot of this in some sections of the media, that surely there's easier ways to keep this virus under control than having to lock down the economy. And I don't think there is. And there's a few things I'd comment on there. One is people will self-isolate anyway if fatalities get bad enough. And secondly, if you wanted to avoid the serious economic damage, you had to do what Taiwan, Korea, or particularly Taiwan, but also Korea and Vietnam did. They acted early, they closed the borders early, they tracked and traced and clamped down on outbreaks very, very quickly. For Taiwan in particular, particularly given its proximity to China, this was not their first rodeo. They've been here, done that before, and they were able to respond very, very quickly. And in doing so, they've been able to minimize the economic damage. But unless you were a Taiwan or a Vietnam or a Korea, this is what you had to put up with. And even if you decided to go down the Swedish path, now, if I look at the performance of the Swedish economy compared to its neighbours that actually shut down a lot harder, there's not a hell of a lot of difference. Sweden has still been in the midst of a major economic downturn. The only difference is they've had a lot more deaths per capita than their neighbours have had. So as much as we would have loved to avoid the economic pain, in my view, unless you acted super, super early, it was pretty much impossible to choose any other path. Controversial view perhaps, but it's mine. Now, the good news, if you like, on the economy, this is why I say there is a recovery of sorts underway. If I look at some of the key indices of business conditions, this is a very timely monthly survey, and what I've done here is just show you the indices for the world, the emerging markets, and the developed markets on the left. And on the right, it's the world broken up by industry, so manufacturing, services, and overall. And above 50 is basically businesses saying, yeah, activity is improving, activity is actually picking up, we're growing. Below 50, we're shrinking. So what we've seen, generally speaking, is this massive fall in activity, but you've started to see the world find a bit of a base. And in some cases, you're starting to see growth off that base. And that's pleasing as things open up. But again, the recovery is still very, very vulnerable to renewed setbacks. This is a similar picture, except just for China in particular. And this is the Chinese business conditions indices. And I've taken this right back to 2005. The downturn we saw in China, the COVID-related downturn, was much more severe than we saw during the GFC. But what we've also seen in recent months is the Chinese economy return to growth. It's still not where it would have been pre-COVID. It's still got catching up to do, but it is returning to growth. Now, let's turn to Australia. Interesting things happening here. The chart on the left shows you what's happened on a quarter-by-quarter basis, the quarterly growth in retail trade volumes. Now, quick caveat. Retail is not the whole story when it comes to the consumer. Retail is about a third of the consumer. Okay, so 2/3 of consumer spending is not in what we would call traditional retail outlets, but it is instructive. The fall we've seen in the June quarter in retail sales volumes is the worst we've seen really since pre-GST and post-GST introduction, where that was a timing issue. People getting in ahead of the GST to buy stuff and then not buying in the quarter after the GST. If anything, the downturn we've seen is worse than we saw during the early 90s recession. So it's very, very clear that the consumer is in a bad way. Even though the month of June saw a bit of an increase, that figure is ancient history well and truly, because it doesn't capture the full impact of what we are seeing in Victoria, for example. What is also interesting is the chart on the right. Trade, if we manage to avoid another negative in the September quarter, it'll be largely because of trade. We're seeing some very, very good export numbers that, despite questions about our relationship with China, and certainly it's very, very hard to say that the leadership of the Chinese and Australian governments are on anything like speaking terms at the moment, because they're not. But in terms of a commercial relationship, China's demand for key strategic resources, most notably iron ore, remains very robust, and the price of iron ore remains very robust. And so the chart on the right shows you Australia's balance of trade going back quite a way, and it's on a quarterly basis. Basically, in the June quarter, we've seen this massive increase in our trade surplus, and what it means is that you're going to see this trade-off: domestic weakness versus external strength. And how that balances out in the September quarter is, I don't know, but it's, if we do manage to avoid another negative because of the lockdown of Victoria, a large part of it will come down to our exports, which are holding up very, very well, all things considered. Now, I just also talked before about how people tend to self-isolate. So even if the authorities don't shut things down, if there's enough of a risk to people's personal safety from going out, they won't. And so I really like this database. Part of me really the economist in me really likes this database. The civil libertarian in me hates this database because it tells me a lot about what Apple know about us. And Google have a similar set of data. This is data from the Apple Mobility Trends database. You can get daily data down to the city, in some cases down to the suburb level, for a range of places all around the world. Okay, this is showing you the number of times someone gets on their iPhone and asks for directions because they're moving about. And they only started in the middle of January. So this basically said, the way to read this chart is, okay, on the 13th of January, let's say there were 100 requests for directions on Apple iPhones. That big fall shows you how, just how many people were just not going out. They weren't looking for directions to go anywhere. And this includes walking, driving, and public transport. Okay, big fall. But notice we have seen a recovery, and the recovery has been particularly pronounced in some of those economies like Italy that went into such a hard lockdown. But what's also interesting is the fact that it's starting to level out in a range of places, and part of this is seasonal. So part of it is perhaps winter in some places. Part of it is fear of renewed outbreaks. But the key point I want to make is, and it's hard to see on this slide, you might have to take my word for it, trust me, I'm an economist, but the number of requests for directions started to taper off in the days leading up to the lockdown in Victoria. In other words, people weren't waiting for Dan Andrews to make an announcement. People could see what was happening, and they were starting to self-isolate, or at least limit their movement already. And we've seen that in various states of the United States as well. Even those states that have not imposed renewed lockdowns and are still somehow hoping for infections to just be kind of magically brought under control. Incompetence is the word that springs to mind when you look at some of the management in some states of the United States in particular. Now, the recovery I mentioned would be gradual and uneven, and very, very hard to predict in time because there's so many factors at play, not least of which is the risk of renewed outbreak. So what factors will determine success or failure in terms of the economic recovery? Now, here's a list I prepared earlier. It's the macro policy response, not just the quantum of dollars you throw at the problem, but the effectiveness with which that money is allocated and how fast you can get it into people's pockets. It's also, who do you trade with? If you trade with really severely affected economies, well, you're not going to be doing as well as trading with those economies that have got their act together. How successful you've been at infection control, your financial stability. So, for example, if you're relying on banks to support their customers through this, then those banks need to be in pretty good financial health to begin with. Now, thankfully, in Australia, that's a big tick for us. Okay, but clearly there's a range of factors at play, and let me sort of address some of these factors which might determine success or failure. The first is the policy response. So the chart on the left shows you how aggressive the central banks of the world have been. The chart on the right is how aggressive governments have been. And the way I've shown it here is the chart on the left shows you how much extra liquidity has been injected into the financial system. Let's take it as read that interest rates are pretty much 2/10 of stuff all everywhere. So interest rates are now off the table. So much more of the central bank's response is how much money are you injecting into the system? So this chart shows you the size of the central bank's balance sheet, or in this case, the size of the assets of the central bank relative to the size of the economy, and in particular, what's changed in that variable from December 2019 to the end of May. And it just goes to show you that Australia was didn't participate in quantitative easing the first time around, But this time we certainly have. They're not calling it that, but they certainly have injected a large amount of liquidity into the financial system, into the banking system. But clearly the Japanese, the Canadians, the Americans, the Kiwis have all stepped up large. The chart on the right shows you what governments have done. This is deliberate tax and spending decisions to support growth and to really help build that bridge from so that people can survive lockdown in reasonable financial health. How aggressive has fiscal stimulus been relative to the size of the economy? And once again, economies have generally stepped up. Governments have actually stepped up substantially, and the fiscal policy response has been very, very aggressive. There will need to be more. If, in the case of Australia, if by our own admission, the forecasts have been rendered obsolete by the Victorian lockdown, and even before the lockdown, you basically were forecasting 200 to 250,000 jobs to be lost between now and Christmas. You're going to have to do more, because that sort of economic pain, you can't just write that off and say, well, stuff happens. And certainly the government does have the firepower to do that. The next slide, I talked about containment success. Now, since I drew this chart, things have changed. There's been a fairly wide degree of success in containing the virus. Now, what I've done is I've built my own little chart here. I basically created an index of success or failure when it comes to containing the outbreak. And it's firstly, how large was the outbreak to begin with? So your total number of cases per head of population. Secondly, how fast or how quickly have you brought it down? So what's the percentage decline from peak to trough? And thirdly, what's your recent experience been? So the last 7 days versus the previous 7 days relative to population. And when you do this, it's no great surprise that the Brazilians, the Americans, and the Chileans look terrible. The Chinese, the New Zealanders look pretty good. Australia has slipped a few notches very clearly since I drew this chart. Okay. Now for Eurozone, by the way, when I talk about the Eurozone, I basically don't mean Eastern Europe. I mean all those countries, the 26, 27 countries that use the euro and basically are part of the European Central Bank's bailiwick. Okay. The next slide, I just want to talk a bit more about markets. So look, let's sum up all that. The recovery is underway, but it's going to be very gradual, very uneven, with lots of setbacks. You can't even pick a letter from the alphabet. V's and W's and U's just don't provide an accurate, stylized representation for what is going on. It's going to vary dramatically across countries, regions, and industries. And frankly, some industries, even when they recover, we don't know exactly what those industries will even look like in the recovery phase. Sections of retail being a case in point, but airlines being the most obvious. Okay. The other thing, though, is in terms of markets, and I touched on this before about just how those big US tech companies have been so much of the story behind share market returns. And if you wanted to manage shares, if you wanted to run a share portfolio and do pretty well, certainly better than your competitors and better than the benchmark over the last 6 to 12 months, last six months in particular, what did you need to do? Firstly, you needed to be very much overweight the United States. Secondly, you needed to have stocks that were largely focused on growth stocks, not value stocks. So in other words, growth stocks that tend to trade at higher valuation multiples, that tend to produce higher returns on equity, for example, and tend to be higher quality, but not always. And this chart shows, and in particular within that growth universe, you needed to like big tech. More on that in a minute. And the rise of growth shares. So what I've done is divide the Australian and US stock markets into growth names versus value names. And the fact that these lines have gone up just tells you that growth has outperformed value. And look at the extremes we've gotten to in both charts. The last time, if you go back in history, when did we reach these kind of extremes? One obvious one was the tech bubble. And in the case of the United States, you've really got to go back to the early 70s when it was all about electronics type names that really dominated things. So this is a very, very extreme market environment that we're seeing. This doesn't tell you that things crash in a heap or that Facebook is going to halve in value next month or anything like that. It just does highlight the extremes here. The next chart, just to sort of go into technology a bit more. Now, this shows you basically the market value of the big American tech names. So we're talking Facebook, Amazon, Alphabet near Google, Netflix, okay, Microsoft. So these are, and Apple, okay, so these big 6 companies. How much are they worth? Well, this shows you, looks at how much they're worth at the end of July, or the end of, I think it's end of June or July, I can't remember. It's hidden on my screen, versus where they were in 2014, which is when they all first collectively were on the market. Now, I've compared them, I've looked at their value as a share of the entire American stock market and their value as a share of the entire world stock market. And in both cases, I'm including all the companies that are in the world index, including small and mid-sized companies, not just the big names that tend to dominate this index. So, for example, these 6 companies were worth less than 5% of the world in 2014. They're worth more like 12 or 13% of the world today. The world, 6 names. In the case, even if looking at the United States, you know, these 6 names are now worth 20% of the entire US market. And that is, you know, nearly 2,500 companies. So I'm not saying, and to put it in a tiny bit more perspective, these 6 companies are now worth nearly as much as the entire emerging markets universe, including China, okay, and including all the small and mid-cap names in that universe, okay. They're worth about 96% of them. So does that actually make a lot of sense? Longer term, I'd argue it doesn't. It just goes to show you how dominant these companies have become. Now in bond markets, now this is a little esoteric because I know bond markets tend to make people's eyes glaze over, but please bear with me. Yields are so low that the investment returns you're likely to see from cash and bonds for fixed income portfolios are likely to be very, very low for some years to come. What can we do about that? The answer is not a hell of a lot. We can't conjure up very safe and very high returns. There's a fundamental contradiction there. I can't conjure up a very, very high risk-free rate from thin air. I can add a bit of value over time by taking a bit of credit risk, by picking up a bit of extra yield, by investing in corporate bonds and other non-government securities. And what this chart shows you is the extra yield you can get by doing that and how that's moved through time. So the chart on the left shows you the numbers for the world bond universe. And what we saw during this crisis was that spread blew out. And what it means is that a lot of people were dumping corporate bonds and flooding into cash and into treasury bonds because they wanted safety. So those yields, those spreads widened dramatically. They have come in considerably. And the chart on the right shows you what's happened to junk bonds or high yield bonds. So these are bonds that are considered below investment grade in a credit rating sense. Same sort of thing, massive spike in these spreads, but they have come back very, very quickly. And it goes to show you how quickly liquidity was injected into these markets so that a whole range of these companies could continue to borrow money to fund their operations. So the other thing I just bear in mind, if yields on Australian government bonds are, say, 0.8 or 0.9%, I can maybe add 20, 30 basis points on top of that, but I can't double it, I can't treble it. The rates are what they are. So it just goes to show you that the yields I'm getting on fixed income securities are going to be very, very low. So the returns are going to be very, very low. What can you do? Look, and this is just from our perspective. We're still finding that in this kind of environment, are there assets that are holding their own during what are very, very difficult economic circumstances? And the answer is yes, there are. Doesn't mean they're immune, but there are some assets out there that are still continuing to function. This is a piece of property we own in South Sydney. It's the Australian Technology Park. Gladys did the opening a few weeks ago. The Commonwealth Bank are currently starting to move in and pay us rent. Well, the Commonwealth Bank are going to keep on paying us rent for the next 15 years with an option for another 15. This is an asset which is going to hold its own and continue to pay income. And we will urgently need that income to continue to pay, especially our retiree members, for example. Another one, electricity networks. This is in Finland. The electricity distribution network in Finland called Caruna. The Finns still keep the lights on. So someone is still paying for their electricity. And as long as they do, there's income to be generated here. And finally, one asset which is doing really well here, if you have property assets that are wholly focused on retail, yeah, those assets are struggling, undoubtedly. But if you have other property assets where the tenants are things like, well, in this case, this is a data center in Switzerland. It's called Safehost. The major tenant is Microsoft. So with everything moving to the cloud and so many people working from home and huge growth in online commerce, et cetera, data center storage space is in big demand. So we bought this asset about a year and a half ago. Is this still paying us an income? Yeah, it is. And that's kind of nice. So pays to be very globally diversified. And I want to make one final point, then I'm happy to take questions. What kind of economy are we going to recover to? And it's particularly the case here in Australia. And I just posed this. It wasn't as if the Australian economy was in fabulous shape going into this. We already had a situation where we had rather high levels of household debt. Now, I'm not one of these people that's overly paranoid about that. I think the concerns about that have been overstated, but nevertheless, we did have very high levels of household debt. We still do. And we also had a situation where the labour market, we still had plenty of spare capacity in our labour market. And as a result of that, we weren't seeing people's wages go up terribly fast at all. And this just highlights that those concerns have been exacerbated by this crisis. So this chart shows you, and it's a little bit vague, but please bear with me. The amber line there is an indicator of what's called labour force underutilisation. So this is the unemployment rate plus the underemployment rate. Those people working part-time, they want more hours, they can't get them. We already had a fairly elevated underutilisation rate. It was already around the sort of 12% mark. Now it's around 20, okay? The blue line there is the rate of growth in private sector wages. And you read that from the right-hand axis. Now, you may cunningly observe that I've actually inverted that right-hand axis. And I did it so I can get these two lines to move together on a chart, because that's what economists aim to do. So when the blue line is rising, it means that wages are slowing down. So eyeball that chart and you tell me where you think that blue line is going to be heading in the next 12 months if the amber line has spiked to 20%. It's telling me that I don't know anyone who's going to get anything like a decent wage increase. In fact, most people may end up getting absolutely nothing, even if they are lucky to hang on to a job over the next 12 months. This is not a recipe for consumers to really race away and spend up big in any kind of economic recovery. And on the business side of things, the ABS has done some really good survey work through all of this, where they've looked at businesses and asked questions about how you're faring and how you're being affected by COVID. And they did this really good survey of several thousand businesses across the economy not that long ago. And it highlighted just how precarious business finances were across large parts of our economy. Now, this chart is just one piece of that survey. They asked businesses, how much cash do you have on hand? How many months could you survive an operation with your cash on hand? Okay. The number of businesses saying less than 6 months, something like 50% of businesses in the survey. In retail, it was more like 60% of businesses in the survey. And I think there was something like 20% of businesses who said we got less than 3 months. So there's a lot of businesses out there, especially small to medium businesses, that were frankly not doing all that well financially going into this. And what it tells me is that when we do go into a more sustainable recovery, the sad reality is that not every business will survive. We will see a number of significant business closures throughout the recovery phase. And that's a sad truth. But part of it is because governments cannot and perhaps should not try and save everybody. But also going into this, we weren't in that flash of shape to begin with in many ways. Let's just sum up that and we'll just have some questions. Very, very deep global downturn, worst recession in any of our lifetimes, without a doubt. Paul Keating once famously said the early 90s recession was the recession we had to have. That may or may not have been true. This one is very much the recession we had to have to deal with a health emergency. Thankfully, governments have done a fair job of building a bridge from where we were to where we need to get to, but they need to do more. Opportunities are presenting themselves. Undoubtedly, those opportunities will continue to present themselves, even during recovery. The question came through, do we see more mergers and acquisitions? Absolutely, we do. That there will be a lot of corporate activity where a lot of companies who will get into stress and they'll be swallowed up by stronger peers, I strongly suspect. There will be a large amount of activity in private equity. Private equity going into this, a lot of big private equity funds were sitting on a lot of dry powder, looking for assets to buy. They are looking to take advantage of this, okay? But they'll do so, the better private equity managers will do so very cautiously. This is not a time to be throwing money at anything you see. It's a time to be very selective and very cautious about taking advantage of opportunities. That's about it from me. I hope that was useful. There's been some questions online, but I'm more than happy to take more. I hope everyone's staying as safe and well as they can through all of this, because it's obviously perhaps the most stressful time in any of our lifetimes.
Thank you, Brian. Yeah, there are a couple of questions which I'll go through, but thanks very much for the presentation. Very enlightening. One of the questions that has come through is around infrastructure, and is that going to be our, I guess, ticket out of this recession?
It's a good question. I think it's more the ticket into it. It helps make the recovery more robust than it otherwise would be. For example, right now, let's take the extreme example of Victoria. If Scott Morrison said, "Great, we're going to start building a lot of infrastructure in Victoria tomorrow," no one is allowed to go out and build this stuff. So you don't want infrastructure to be built now because you don't want anyone doing it. But as the recovery takes hold, especially if we're going to have several 100,000 more people unemployed, there's going to be more work that needs to be generated. And so I think infrastructure will help. Governments need to be prepared to step up and help. So yes, the short answer is yes. Do I have a lot of confidence that they'll get this right? I'd like to say yes. I'm not sure I'm convinced. But yeah, I do think that infrastructure is certainly part of the story, because right now Australian governments can actually borrow long-term money more cheaply than at any time since European settlement. Market participants are queuing up to lend money to the Australian government for long term, for the long term.
And a question from Chris around the US market, and if you think it might be artificially inflated, particularly going back to your comments around the tech space and the proportion they represent. Do you think it's a bubble?
I wouldn't say it's a bubble. I do think they were severely overvalued, and I think tech stocks are overvalued. Now, mind you, tech stocks today are not like tech stocks back in late 99, early 2000, where frankly profit was an optional extra, right? Where they weren't making money. Okay, but now a lot of these names, they're not making a lot of money, but they are making money. So to the extent that there's a profitable business model there, that's great. So it's a different kettle of fish to, say, the tech bubble of the late 90s, early noughties. But I do think they're overvalued. And if I look at what our managers are doing, they're voting with their feet. Managers generally are probably a little underweight developed market tech, but they like emerging market technology, which is interesting because those stocks look cheaper than the big developed market names, just quietly. And there's a preference for Europe as opposed to North America. Mind you, you cannot sell the US market short. The US market has outperformed European shares for maybe, I'd say 28 of the last 30, 31 years. So to bet against the United States has been historically very difficult. And I certainly would not want to be avoiding the United States market wholus bolus. There are still opportunities there, but certainly those big tech names are looking very fully valued. That's certainly what our managers are telling us. And our own modelling, our own asset allocation modelling, even if you give the US market the benefit of the doubt and say, sorry, the US is just exceptional, it's just going to be more profitable than anywhere else, you still come up with a theory that says Europe looks cheaper.
Thank you. And I guess something that hasn't been touched on and potentially a spanner in the works, the upcoming US election.
Oh, yeah, that's a good question. There was another, I think I meant to mention something about property, so you might want to throw me a question about property after I deal with this one. Firstly, look, let's make this very, very clear. Let's put economics to one side here, okay? So much of the health of the world and so many of the world's major problems, COVID being the latest, relies on US leadership, relies on the US being led by competent, smart people who are globally focused. We haven't had that for 3 years, okay? Trump the man is barely literate and he's a moron and he has no interest in learning what's really going on. He's just, I'm sorry, he's every bit as bad as people feared he would, and I'd argue worse, okay? Now, so American competence is crucial to the overall health of the world at so many levels, okay? And currently we have a situation where the Chinese and the Russians look at what's happening in the United States and they can't believe their luck. Okay, so the sooner we get to American competence back, the better. Okay, now is Joe Biden the ideal candidate for that? No, he's not. The man is getting old. The man is not. Yes, he's an old man, but guess what? He's not a crook. He will actually surround himself with very smart people. He does know how to do the job, and he will actually be a safe pair of hands. Not a long-term safe pair of hands, but he's going to clearly be a much better alternative if you believe that American competence is so crucial. Now, in the economic side of things, there is some talk that, sorry, well, a Democrat administration is really bad because they'll raise taxes and they'll be really bad for the market. I'd argue that Democrat administrations have actually been really good for equity markets. Equity markets have still done really well under Democrat administrations. You saw very significant equity market gains under Obama and very significant equity market gains under Clinton. There's no reason to be terribly panicky about the long-term health of share market performance based on the November result. So, and the other thing is that will taxes go up in the United States? They probably will. Will that cause markets to be a bit unsettled for a while? Yeah, maybe. But longer term, no, not at all. And I would argue that markets benefit from capable American leadership creating a far better global environment. Because frankly, at the moment, we don't have it. This idea that, oh, but Trump's not as dumb as he sounds. He'll surround himself with smart people. He'll grow into the role and he's a successful businessman. Now, none of that was ever true. And now that's been proven unambiguously, just quietly. Sorry, rant over. Now, did you comment quickly on property here? Yeah, sorry, because I know you did ask me to comment on it, and I clean forgot when I was in full flight about 20 minutes ago. We have not seen a bloodbath in residential property in Australia thus far, which has probably fallen short of people's expectations. I think a lot more people thought we'd see a lot more damage in property. But to me, so much of it comes down to unemployment. And so much of it comes down to the idea that those sort of 10 to 15% of people who've got their mortgages on hold, how many of them will ultimately be forced into selling because they'll suffer a permanent loss of income or they'll lose their jobs outright because the government support measures or whatever don't continue to support them, or their industry they're in doesn't come back to anything like normality. It's that if they end up being, if you end up seeing a much more painful rise in the unemployment rate than we've seen so far, then you end up with people being forced to sell. And that's when you get a significant leg down in parts of the property market. Now, that said, I don't think we can generalize here. So clearly, there's going to be some parts of the property market where if that cohort is overrepresented, that market is going to be in trouble. To the extent that that part of the market has been sort of overextended, or perhaps has been overextended into buying some investment property or whatever, you could see some quite significant forced selling and some quite sharp falls in prices in parts of the economy. But I don't think it's a cross-the-board, nationwide 30% fall. I don't see that. But I do see the potential for serious damage in parts of Victoria and indeed in parts of New South Wales, because it so much depends on unemployment. But I do think that fears of 30% down across the board, I don't buy that. Because I don't think the damage will be that great, and also to the extent that people are forced to sell, there's a bunch of people who've been sitting on the sidelines for some time looking to buy, and interest rates are very, very low and going to stay very low for some years. So, the other thing, just a quick caveat, those parts of the market, most notably in the apartment space, that have been so heavily dependent on whether it's investment property for university students or immigration flows, they're in trouble. I think that's where you see significant damage, because our immigration flows will slow to a crawl over the next 12 to 18 months, down from 160, 170 down to 30 on the government's own forecasts.
Thank you. And we've got a question from Brendan about concern around the level of Australian government debt with all this stimulus.
Good question. My level of concern is relatively low. If I look at, this is an emergency. This is not your typical. This is like a war. It is. We went through World War I and World War II, and we accumulated much larger levels of debt, and we ended up growing out of them. That tends to be what happens. Now, I'm not one of these people that says government debt never matters. It's not. I don't buy that at all. But at a time when the private sector's demand for money and demand for funds is so weak by design, this is when government should step up and fill the void. You only get a problem, really, I think, when the governments are trying to aggressively compete with the private sector. We don't have that at the moment globally. So right now, what are markets telling us? Markets are telling us we can borrow long-term money very, very cheaply for a very extended period of time, and we should. Over time, we do need to wind that back, and over time, as the economy recovers, we won't need to be doing that sort of borrowing. But I don't really think, and also if I look at the absolute level of debt, both gross and net, we're still very, very low by international standards. So I'm not saying debt never matters. There's a time and a place for everything. Okay. Now is not that time. I think we can, which means to me that we can afford to do more.
With regards to the Australian market and the top 200 companies, do you think that potentially is overvalued? And do you think index funds have a contribution towards that?
Look, I'd say no. I think, and one caveat, if I look at the absolute valuations on Australian equities, I don't think they look excessive overall. I don't think the market is looking in bubble territory or anything like that. If I look at Australian equities relative to alternatives, if I look at relative to the alternative of not taking risk, i.e. cash, bonds, term deposits, equities are the only game in town. Even with likely pressure on dividends, and I think that pressure doesn't go away quickly, the income alone you're getting from Australian equities over the coming years is going to be heaps better than the income you're going to get from any other conservative income earning investment. So I still think that equities look relatively cheap. Our own modelling, we want to be overweight equities because our job is to generate long-term returns, and we are not going to do that by parking money in cash and term deposits. We'll get it from our unlisted assets, but we'll absolutely get it from equities as well. The March was a buying opportunity. Absolutely a buying opportunity.
We've probably got time for a couple more questions. One is about the agriculture sector, and where do you see that in the medium and long term?
Don't have a strong view. For example, we every now and again get questions about, well, why don't super funds invest more in agriculture? And the short answer is, in order to do it in a very risk-free way, you need to really own massive, massive properties to make sure your risk is diversified. Australian graziers have known this ever since European settlement, right? That and the additional risk that you're running in portfolios. So we would argue that given the cost involved in managing these assets, the volatility in the returns you get from the assets, that the risk-return trade-off relative to the costs you incur from investing in it doesn't really stack up. This is not to say we never would. It's just that whenever we've looked at it, that's been the conclusion we come to. Is there still going to be investment opportunities for people with expertise in this space to generate good long-term returns from Australian agriculture? Will Australia remain, a highly valued source of agricultural output for the world? Absolutely. So I'm an optimist there. But again, one thing I'd also add, though, is that I still look at the way we manage water in this country, and I still kind of despair. Which is probably why I don't analyse agriculture as much as perhaps people might think, because it is a relatively small part of our economy, decent chunk of our exports, but a relatively small part of our economy. And whenever I do think about our ability to manage water and the allocation of water, I get somewhat depressed. I don't really have anything extra.
No worries. We'll probably wrap up with one final question. And apologies for those who've missed out. We'll try and get back to you over email or something like that. But question about unemployment and the forecast of 9.25% by December. Do you believe it might be higher, or do you think the likes of JobKeeper will probably keep that at a lower level for some time?
Look, I think seeing what we've seen in Victoria, it's almost certainly going to be higher. Seeing what we've seen in Victoria, I think that the government is probably going to have to wind back its decision to wind back JobKeeper. I think they probably have to end up doing more here, because literally that package was rendered obsolete very, very quickly. So I think the risk is the unemployment rate does actually end up somewhat higher than that forecast. But also I'd caution that economic forecasting is a mug's game at the best of times. It's even harder now because we really don't have any great historical precedent for how we can't look back at precedent X and say, well, this is how the economy responded then, and this was the kind of damage that was done. Therefore, we can use that to inform our forecasts. Back in the Spanish flu, we didn't publish monthly unemployment stats. No idea how the economy did then. We know it was bad, but we don't have any stats to guide us at all. So that'd be my sense. So yes, unemployment ends up a bit higher, but I think governments end up stepping up, and probably sooner rather than later. And I think we've seen a start of that already in the last little while. All
right. Thank you, Brian. With that, I'd like to sincerely thank you for joining us today. I know you're a busy man, so it was a very enlightening update. And we hope everyone out there got some value out of that. If you do have any questions on today's presentation, reach out to your advisor, myself or Byron. We will be sending a recording of today's presentation and the slides to you via email. But yeah, thank you, Brian. Hope everyone stays safe and well out there, and we'll touch base soon. Thank you.
Thanks very much, everybody. Enjoy the rest of your day as much as you can. And regards to everybody.
Thanks for coming, everyone.
Thank you.